I don't think we're going to have yield curve control. I don't think the Fed's going to go in cap rates. And I think that because I think the Fed wants a steeper curve. Because I do think if we do get to that level, I would call it a financial tsunami.
Especially in times of crisis, 60-40 and risk parity portfolios are underpinned by the inverse correlation between stocks and bonds. But with rates at the zero bound and the potential for inflation to push rates higher, we may be fast approaching a period where stocks and bonds go down together. This would be devastating to financial markets, and it's exactly why some of the brightest minds in finance are focused on finding the best ways to hedge these risks.
One of the best parts about going to work with you now at Simplify is that you and I get to do this a lot more. So you and I had not sat down for almost probably 2 years in front of the cameras the last time we did a Real Vision segment. Now you and I are sitting down regularly to do our own podcast. We're doing situations like this where we're talking about stuff with a Real Vision audience. One of the things that is so incredibly exciting about what's going on at Simplify is that you are contributing products that are truly OTC or require ISDAs in nature. This is a big change. This is something that's never come to the ETF space. And we were having a conversation offline where I dig into the market structure and the regulations and like why we're allowed to do this, and you're kind of sitting there instead really focused on the actual product itself. This was a bit of a surprise to you in terms of the change in regulations that actually allowed you to do what you're doing. But talk for a second about the strategy itself and like what you were thinking in the world that led you to put forward this interest rate hedge strategy that you brought up.
The entire idea of long-dated options, long-dated derivatives has always been very interesting because there aren't that many guys that go there. But why it's so interesting and why it was so opportunistic is that structured product is very popular on Wall Street. It's a way of taking certain risk vectors and enhancing or softening them up and giving them to retail. So like in Europe, older population, they like to have dividends, capital gains. They don't have the same taxes we do, whereas the US capital gains are more valuable. In Europe, it's not that way. So it creates risks that have to be sold out in the future, 5, 10 years out. In the US, we have similar supply-demand disequilibrium. For instance, insurance companies in Taiwan, they want extra yield for their bonds because they have very long-term liabilities. Insurance policies last for, 20, 30, 40 years. And they sell optionality out 5, 10, 20, 30 years as a way of enhancing their yield. They're selling convexity. They're selling a profile. They're not taking credit risk. They're taking convexity risk, path dependency risk. And when they do it in big enough size, that creates very cheap options, 5, 7, 10 years out. And so I was looking at this when I was on Wall Street saying, wow, this is a very interesting opportunity. And as I left Wall Street, the clever idea is there a way to offer this risk? I wouldn't call it risk, I call it insurance, profile, payoff, exposure to ordinary people. I call civilians, which doesn't mean they're not warriors, but it means that they're not professionals, and it means they can't get an ISDA. An ISDA contract is technically only available to commercial users, insurance companies, hedge funds, big money managers. Ordinary people really can't get them. And so piercing the ISDA veil to take these interesting opportunities and make them available to ordinary people in a controlled fashion was exciting to me, and joining Simplify was an incredible opportunity.
In Asia, within a single generation, well within a single generation, they've gone from 9% interest rates to effectively 0% interest rates. They're now faced with a generational issue of how do I obtain the additional yield that allows me to fund both the current retirements and, as you point out, some of the extended liabilities. And one way to do that is by selling that volatility in the form of optionality, increasing the yield associated with foregoing some of the capital gains dynamics that could otherwise accrue. Right, so that's one of the components to that trade.
Well, you may have forgotten, that's how we met.
Is that really how we met?
When I was at Credit Suisse and you were at Canyon, I came to you to show you a structure where you would sell a 2 or 3 year option and then buy a 10-year option.
Yep.
Because of this Formosa bond discounting of vol, and you actually bought them.
Where I'm buying and selling an option at different points, going to a particular stage in the process where I'm maximizing the carry characteristics or minimizing an expense component of it so that the trade carries really well. Like that's what I've always thought of as the Harley signature, right? It's this idea of how do I obtain optionality for a period of time, almost never the length of the actual contract itself, but for a period of time that gives me access to that without having to pay an arm and a leg, which you often do in option space.
Those are good trades. Too clever by half for what we're doing right now, though. Right now, the back end part is cheap enough where you just buy it alone and it'll work.
Well, but here you're also doing something very important. You're going out and you're striking yourself at a point in time on this strategy, right? So you're doing a 7-year into 20-year. Explain what that means quickly.
The strategy is you're going to go buy an option, a 7-year option on the 20-year rate. And this is functionally, effectively like buying a 7-year option on the 30-year treasury. 7 years because of various dynamics, volatility, implied volatility is extraordinarily inexpensive back there. Probably could be 20% less than a 2 or 3 year option of implied volatility. And then the strike of 4 1/4. Well, let's get into the conversation we've had before about the grand correlation of stocks to bonds. So for the last 20 years, you've seen stocks up, bonds down, and vice versa. So they hedge each other. This kind of underpins the 60-40 portfolio. But what it really kicks into is what's called risk parity. Bridgewater, they do this. And what they'll do is they'll take $100, the ordinary 60-40 strategy, you buy $60 of stocks and 40 of bonds. Let's go and turbocharge that and buy $130 of bonds and $70 of stocks. So now you have $200 of exposure for $100 of capital. And if they go like this, a certain correlation, you actually even make more money with the less volatility. And that's worked quite well. The rub is it seems, and we have this in the chart book, if rates get above 4-ish, somewhere 3.5 to 5, inflation gets above 2.5-ish, that correlation will flip, and that you'll have stocks and bonds go up and down together. And if you look back in the last number of years, the biggest drawdowns have occurred March of a year ago, and then before that in December of 18, you had stocks and bonds go down together. When that happens, all the leveraged money who's long the 130 and the 70, all of a sudden both are going down at the same time, they got to get out. And this was actually why the Fed had to step in a year ago, is that you had stocks and bonds and gold and everything going down at the same time, creating a giant global margin call, which they had to stop, and they did. What I'm saying is that let's go buy an insurance policy so that if rates do get up to that 4 1/4 level, you're going to go and be able to sell bonds, be able to go and make money if rates go even further higher, to go and insure your portfolio. Because I do think if we do get to that level, I would call it a financial tsunami. Will we get there? I don't know. I'm bearish. I'm not sure if you are. I think rates are going higher. I'm not sure how fast they're going to go. But I do feel comfortable that if we do get rates up at that level, it'll not be pretty.
One of the things that you're effectively saying is interest rates and inflation become high enough that the Fed is going to be forced to start thinking about inflation. Instead of the Fed reaction function being exclusively tied to the idea of how do I protect financial markets, in a rising inflation or higher inflation environment, which would tend to accompany the 4 1/4, and again, whether that's tied to much higher real growth levels, whether that's tied to an inflation that has begun to take off in a way that makes the Fed feel uncomfortable. What you're effectively saying is that the Fed's reaction function begins to shift, and so they're no longer able to exclusively focus on the idea of protecting the asset level. They have to start thinking about the inflation component.
2 points. One is inflation goes up, then bond yields go up. That's supposed to happen. It might not. I mean, in Japan, they're doing yield curve control, where they're basically pinning the 10-year at 0.1%. I think it doesn't matter where inflation goes to. They're going to pin it there. We did the same thing in the U.S. in the late 40s and early 50s, where we pinned the back end to 2%. Could the Fed do that right now? Yeah, we can have inflation of 4. We can have the 10-year locked at 2. The Fed will buy all comers, empty bid. What happens then? Well, you have a massive negative real rate. What would happen is the currency would collapse, or that should happen. I don't buy that. I don't think we're going to have yield curve control. I don't think the Fed's going to go and cap rates. And I think that because I think the Fed wants a steeper curve. Not radically higher, but up a point or two, that is good public policy. If we steepen the curve by taking back rates up, what happens is all the pension liabilities, the insurance liabilities, they all shrink because they have to go and borrow money, and to the extent that rates are higher and they can reinvest higher, they can get the money back sooner. And with this retiring baby boom demographic, you need our pension insurance companies to be solvent. Banks will make more money in a steeper curve. Are banks the good guys? No, they're not. But nonetheless, we're a financial economy. We're a levered financial economy. We have a plumbing system of money moving around, and therefore we need the pipes to stay clean. And if banks make more money, they'll be more sturdy, more solid, they'll have a higher capital cushion, they can withstand more volatility. That's a good public policy good. We have, when rates went down, it wasn't a free lunch there. We were robbing Peter to pay Paul. Borrowers could borrow at a lower rate and get the economy going and hire people. I guess that's a good idea. Savers, they lost the money. Well, we have this big demographic of people retiring. If they are investing money and earning 1-2%, they're probably going to need federal government support as they retire. If rates are 4-5%, well, that lessens the burden of the federal government having to do transfer payments to go support people, which is probably a public policy good. And could businesses survive borrowing at 4 versus borrowing at 2? My guess is yes. I don't think a factory is not going to be built because rates are at 4 and not 2. Now rates at 10, it's a different story entirely. So all these things wind together tell me that the Fed probably wants higher rates going forward.
When you talk about this dynamic of 2 to 4% rates, does that really matter for businesses? The quick answer is probably not, right? Except for highly levered businesses, which in many cases is effectively the zombie corporations that we're trying to get rid of anyway.
Right? So, anyways. Yes, that's the problem with Japan.
So this is actually one of the issues that's created when the Fed constantly is stepping in and bailing out the system by lowering interest rates, is that you're keeping competition in existence in a market that deteriorates the profitability of the superior businesses and creates a negative feedback loop that then requires even further rescuing at some point in the future.
They had their chance 2013 to let rates rise 100 basis points, taper tantrum, they chickened out. When we look back at history, we'll point to that as being the big mistake of this whole cycle. Similarly, in the previous cycle for the great financial crisis, Greenspan raising rates at a measured pace, where he said, I will take rates up 25 cents every 6 weeks. It doesn't get worse than that. Once you say that, everyone in the world can go and put on massive levered trades betting that rates will go only up 25 cents. That's why the GFC was so large, was everyone was over-levered and over-risked. If he hadn't said that, just taking rates up randomly, we would have been in much better shape.
And you talk about this large group of individuals that are retiring, right? So these are mostly the millennials and Gen Zs who've bought Bitcoin, right? So no, you're talking about the baby boomers. When you think about that dynamic, that cohort retiring and moving into a saver only or an asset earning category, right? They're no longer really generating working income. They're only taking it off of the interest side of the equation. How do you think about that dynamic playing out relative to the productive capacity in the economy, the need for the younger generation to buy houses, be able to afford those houses at the low interest rates that we have, et cetera?
The demographics are baked in the cake. We know how many people are going to be born, what age they're going to be, except for immigration. And theoretically, 2023 to 25 should be an inflection point of where the boomers are retiring at a faster pace than the millennials who are coming into work. And the labor force growth rate is actually the key driver to inflation. And this should create, it should increase inflation because the demand of the millennials getting married later now than our generation, my generation, they're going to buy a house, buy a car, buy a baby carriage, buy a washing machine. There's a demand pull, and they're going to be pulling that demand from a smaller supply. This was the source of the 70s inflation shock, actually. I mean, as much as I want to point to guns and butter from Johnson, it was more the boomers picking the python through the system. And I have a fabulous chart that shows this relationship of interest rates and the labor force growth rate.
Most people think about labor force growth as on the cost side, that it increases the supply of labor, therefore it lowers business cost, therefore it results in lower inflation. I think you and I both look at it the same way, which is no, it does the exact opposite. What you're actually doing when somebody enters the labor force is you're saying very explicitly, I want to increase my consumption. Otherwise, you'd sit on a sofa like you and I are doing right now and just, you know, enjoy the life that you already have. The minute you decide that you're going to go to work, you need to put on a suit. You need to get transportation to the office. You need to, you know, start buying your lunch at a restaurant, or at minimum, you know, packing a brown bag. We've seen this in reverse in the pandemic, and as we see things start to turn back on, we're seeing elements of this where, you know, you go to the office suddenly, or as people start returning to the office, the local sandwich shop may be closed, or it doesn't have the capacity.
You have this double-barreled, you know, wave coming at us. One is the demographic. The second is the money printing and fiscal expansion of the government, which I think, you know, for various reasons is going to go accelerate inflation. This should go and increase rates. And so the strategy that we've offered here is a long-dated option to people. I won't say retail, it could be anybody. Anyone who doesn't have an ISDA, which is most people. So point and click on the exchange. And the beauty of this product, aside from the pure value proposition of buying low insurance, low implied volatility, and you're buying it now when rates are low, is really the direct drive proposition. There's nothing else out there. There's no other ETF that has this, where you could say, if rates go up by 100, I will make X dollars over a certain amount of time. Everything else is correlation, finger in the wind, maybe it'll work, maybe it won't. The only other product, there is a competing ETF that's like the inverse of interest rates. That's a terrible product. If you want to go and trade for a week, it's fine. Anything more than that is a loser because the structure. The structure is you buy at 100. If it goes down to 80, that's down 20%. You have to go up 25 to get back to 100 again. Well, if you think about that, as you go up and down, this product's going to go south. So you can't hold it for more than a few weeks. Ours is built for, you know, to hold at least 2 years. The only other product out there that's even close would be futures contracts, which once again, most people can't do. And if you did want to do it for 2 years, you have to roll that product every quarter, right, creating a taxable event and risk and everything else. So this is really a first. And what you could do with this is kind of size it properly. I've been saying roughly back of the envelope, 1,000 shares is going to roughly give you a coverage of $1 million of bonds. So that's kind of the idea. From there, you can model it up. There's one option in there, basically, and it's easy to model on Bloomberg or any other, you know, Excel spreadsheet.
Well, I think this is one of the challenges is for most people, not only do they not have access to the ISDA, but they don't have access to the modeling capability that could answer that. So it's really important when you start talking about that dynamic of how do you think about what this hedge is. You're talking about basically hedges $1 million worth of long bonds, right? So the 20 and 30-year bond sort of exposure, not necessarily a, you know, i.e., not necessarily a 5-year type bond exposure.
Well, the thing is this, I mean, I don't want to get into the weeds here, but the underlying is like a 30-year bond. That is functionally true. But it's also an out-of-the-money option, which then reduces the localized movement is much less than it would be for a 30-year. That kind of waters it down. So at the end of the day, it kind of washes out. So I think using that as a rule of thumb is a good start. I hope in the future, near future, to work on some modeling profiles, comparing it to other various instruments, the Lehman Ag, an ordinary bond portfolio, a muni bond, any of these various things, to see how you would size it and how it would look. A whole lot of assumptions. In my last commentary, I urge you to go to the back. This is not a promise. It's a modeled profile of a strategy. And I've made a lot of assumptions. I think they're conservative assumptions, but they are assumptions. And you should, at the very least, look at it before you kind of get involved.
That disclaimer, I think, is really important, right? That this is Adult Swim. This is a product that is designed to function as a part of a portfolio that holds bonds. But it also has the interesting feature that you were referring to earlier when we were talking about risk parity, of offering a hedge against a very particular type of risk in the equity markets, which is this idea that correlation breaks down. And so when that correlation breaks down, you were highlighting the idea that instead of a 60-40 portfolio, just to make life simple, we're going to say a 120-80 portfolio, right? So you're 2 times levered. you're raising the contribution in terms of the volatility. This is where the risk parity phrase comes from, right? You're raising the volatility of the bond portion of your portfolio by levering it, taking the bonds that would be 6 vol and taking them to 12 vol. The equities at 80% of the portfolio on 16 vol, you multiply that out, you end up also with basically a 12 vol. You're therefore getting equal risk contribution from the bond premium and the equity premium.
As long as the sign is opposite.
Correct.
If the sign goes, so one's plus, one's minus, you're okay. If they both go plus or both go minus, then you're, well, power windows down.
Well, and so this is the reason why you see that delevering, right? Is because what you're hoping for, what you're expecting is that the negative sign between the two, the negative correlation between the two, means that the combination offers in aggregate lower risk than either of the individual pieces, right?
In theory, yes.
In theory. And so when that correlation breaks down, either because you have an inflationary scare or because you have recessionary conditions that are causing different behavior than you would expect, right? That ultimately is what leads to these deleveraging events. And candidly, we saw something like that happen in the crypto space today. We've seen that happen in March 2020 in the equity and bond space, as you were highlighting, in December 2018. Right? In 2008, we saw that correlation breakdown, and in 2000, we saw that correlation breakdown. Right? So every time in the past, give or take 20 plus years, we've seen those correlations break down and force this deleveraging. You're creating this sort of event, which means that this portfolio can create, this strategy can create a component of insurance for the equity portion of the portfolio as well. It's not simply a bond bet.
Oh, there's no question about that, Jack. It's very popular now to consider the FANG stocks to be 70-year duration bonds, because will Tesla make money? Who knows? But if they do, it's 8 this year, it's going to be 30 years hence. And so you take those large earnings and then you PV them back to get today's price. If you're discounting at 1%, you get a big number. Discounting at 5%, you get a smaller number. Mm-hmm. And I think that's very reasonable to think about these tech companies as being very long duration assets. That's not good or bad. It's just the discounted cash flows. I'm fine with that. But that does mean that your stock portfolio, if comprised of these big name, long growth stocks, has a bigger interest rate beta than your ordinary portfolio would.
So I'm going to deviate for a second here, because everyone has heard you and I talk over and over again. I don't think anyone's ever actually heard your full background. You're a California boy who lives in California now. You came east to make your fortune in the mortgage markets.
Went to school at UC San Diego.
Yeah.
I could not get a job out of college, so I went to business school, which you could do back then. You could go straight on through. U Chicago, and then from there I went to Wall Street. I was at Drexel for a couple of years. I was not in the junk bond department. I guess I wish I was, maybe. But junk bonds is a whole different animal. And I started their option business. I had the choice of working on the money market desk or starting the first option business. This was 1983, and they just started trading options on futures like, the year before. The money market desk, like that movie Wolf of Wall Street, all the crazy stuff was going on, it all happened. I was there. It all happened, man. The dwarf going thrown against the Velcro wall, it all happened. In any case, I had been to U Chicago. I had taken the option class. I knew how to program a computer. We only had 3 IBM PCs on the entire trading floor. I was one of 5 guys that could plug it in, and thus I was the one-eyed man in terms of tech. And I built the first option model there, and there you have it.
This was actually a period of incredible innovation in the option space, right? So not only had we had Black-Scholes come out in the 1970s, which kind of revolutionized the way that people thought about systematically pricing options. You also had Cox-Rubenstein. You got to see in that time period the dynamic of LOR, which is Rubenstein as in Leland O'Brien Rubenstein, create the portfolio insurance dynamics that contributed to the crash in 1987, or could have directly caused it, depending on how you want to think about it. In that time period, we became very familiar with the idea of equity volatility. But going back to the strategies that we've talked about, there's also this concept of interest rate volatility. What does interest rate volatility mean? How is that different than equity volatility, which is about the variation in price of the equity, whereas interest rate volatility measures something quite different?
I wrote a piece. It's called Wall Street Babylon. If you want to get dirty, this is one of the best pieces I ever wrote. And it's about the religion of volatility, because there is no right answer. If rates are 2%, moving up 2 basis points a day is the same as rates at 10%, moving 10 bips a day, that volatility is proportional to yield. That's called yield vol or log vol. And that's how we used to price bond options in the 80s, early 90s, because we were taking it from stock options, because stocks are definitely log normal. They can't go negative, but they can go up to infinity. A normal model says the odds moving 5 basis points a day are the same whether we're 2, 5, or 10%. Which one's right? There isn't one that's right. It's really, there's people try to figure them out, but that's the big deal in interest rate option trading, is trying to figure out which of those two distributions is more relevant. The grand revelation in the 90s was that once upon a time they were trading with this yield vol, which meant that we'd be more volatile at 10% than at 2%, so therefore an option at 2% should be a lower price than an option at 10%. And what you found was it was the exact opposite. So if you think about it, if rates go up, that's usually associated with growth and happiness, less volatility. Rates go down, that means recession, that means unhappiness, that means more volatility. So you actually had realized volatility in the late 90s was actually the opposite of the models. And there were a number of people who lost an awful lot of money trying to go and model it one way, and reality was the other. This is getting into the weeds, man, but that's... I think that's what you're talking about.
No, that's exactly what I'm talking about. And I'm glad we're getting into the weeds, because it's actually, like, this is part of what creates the interest around this type of product. This was a huge debate when you and I first met, this transition away from log normal towards normal vols. Yep. We saw that happen in Japan as we moved to very, very low interest rates. And there was actually an incredible amount of debate around what happened at the zero lower bound, because when you and I started interacting in the early 2010s, late post-GFC, there really was no precedent for negative yielding bonds. And now they're all over the place, or they were all over the place.
They're not going to be
less
here.
Today.
So it ain't happening here.
Okay, so that's where I was going. Okay, so why do you say that? What's your thought process on why we're not going to see negative interest rates in the United States?
There's the mathematical one and the fundamental one and the political one.
Okay. If
we had negative interest rates for consumers, you would see people with pitchforks and torches surrounding the Federal Reserve. That would happen. We think it's been bad for those last couple of years with populism. That'd be nutso. Away from that, it just doesn't work. And we are the reserve currency of the world. 2/3 of all trading happens in the U.S. dollar. You can't gut the financial plumbing of the world by negative rates, because it basically collapses your banking system. There is no scenario where that's a good idea for the world's reserve currency. So that's not going to happen.
The way I describe negative interest rates is that they are a tax on the banking system, because for all the reasons that you talked about, they can't pass through negative interest rates to depositors. Depositors will just not put cash into the system. Part of the challenge associated with the Ken Rogoff type model, which is, hey, we could solve all the problems of everything if we just had negative 4% or negative 5% rates. So that's the theory, right?
That would be the Andrew Mellon school of finance, which people may recall, liquidate the banks, liquidate the labor, liquidate farmers. That was his suggestion to Hoover. That didn't quite work. Well, it didn't happen. Hoover lost the election.
In the scenario that we're looking at today, where potentially interest rates are going up, is there any other trade that catches your eye? Is there anything else that you look at and you say, I think this is a good long-term play?
Buying interest rate insurance. That's what this is. This strategy is interest rate insurance. If you want to use it as a speculative tool for rising rates, be my guest. If you want to go and buy and sell it every day or week, I suppose you could do it. Let me be clear. This is a volatile strategy. As structured right now, a 1 basis point move is going to move this thing by 20 cents. So we're to 50.2. A one normal vol from 65 to 66 would take it up by a point. This thing has volatility. It is meant to be a buy and hold strategy sized appropriately. Okay? Let's be very clear about that. That said, you don't buy fire insurance because you think your house is going to burn down. You buy it because you don't want it to burn down. In fact, you're pretty sure it won't burn down, but just in case, that's why you buy fire insurance. This product is being bought by people, if I had my druthers with this thing, is not because they're actually bearish on rates. If you're super, super bearish on interest rates, you don't need this thing. You've already sold all your bonds, right? I mean, or your short futures or whatever it might be.
Yeah.
You're already out of the risk. is for people who are not bearish on bonds but are worried what might happen. That's who buys this thing. You buy it and you put it away, and because of the structure of it, go to page 4 of my last commentary. This thing is a very slow burn. As options go, this decays very, very slowly. And so it just fits into what you want to do. Other ideas, I've written about this in my past commentaries. Can we put this into a ETF? Possibly. But the strategy is this. In Europe, the dividend yield of their Dow 50, known as the SX5E, which is their liquid instrument, that's where futures trade on it, has a dividend yield of about 2.3, 2.3, 2.5, something like that. And the interest rate, the borrow rate in Europe, which is dominated by Germany, is like negative 0.6. Well, take a negative 0.6 interest rate and compound that for 5 years. So you're borrowing money for 5 years at negative and locking it in. And then you're taking this dividend yield and compounding that. This creates, I'm not going into the weeds, it creates strange stuff, such that if the SX5E is at 4,000 right now, you could buy a 4-year option struck right there for about 8.5%. I think the idea that over 4 years, nominally, this thing could go up by, 2% a year for 4 years to cover it is pretty easy. This is the world's best beta trade. If you already have exposure to European stocks, you get out of that and you buy this instead. Unlimited upside, you burn the first 8% clearly. Downside, that's it, you're 8%. And when it hit 4,400 SPUs, the SP 500 was at 2,000. That's the outperformance we've seen in the US versus Europe. Now, will Europe catch up? I don't know, but it sure seems to me if I'm buying this thing at a level below where it was 10 years ago, that's not a bad place to start if we get this push in the economy of the double barrel power of fiscal and monetary policy. By the way, I'm not against these policies. I kind of think we need them. I kind of think that that inflation's a good thing because we have too much debt. We have way too much debt, and the way you get out of debt is you default or you inflate, and inflation is just a slow motion default. As a public policy matter, creating inflation in our economy is a good thing to do.
This is, again, a very classic type dynamic. When you think about that forward that is created, and an option is always struck against a forward. So if the SX5E is at 4,000 today, you've got negative interest rates and you've got a dividend yield of give or take 3%, right? You're talking somewhere around 4% per year, effectively, that is being compounded and priced out. So if I go out 8 years or 5 years into the future, I'm looking at 0.96 to the 5th power.
Yes.
Right? And that then multiplied by the spot today is going to roughly give me my forward.
Yes.
Okay. And so I'm then buying that call option against that forward, which means if I'm buying it at the spot level, the 4,000 level today, that's an out-of-the-money call option. It has lower volatility associated with it, right? And effectively, the break-even is created by the fact that I'm buying an out-of-the-money call option off into the future that raises the probability of my break-even quite dramatically.
You are torturing the viewers right now with your complexity. Let's just make it a little simpler. When I buy a trade like this out 4 to 5 years, I am locking in a borrow rate of negative 0.6. Imagine what you can do if you could borrow money for 5 years at a negative number. All of a sudden, things get really interesting. And there's a lot of things out there right now where taking that negative rate, compounding it out 4, 5, 7 years, and then using that to create some kind of derivative profile is very advantageous. This is a feature, not a bug. The ECB is taking rates negative to create investment, to get the economy going. Well, you know what, man? If they want to do that, I'll take them up. I'll borrow money. And this is ordinarily institutional trade. If we can go find a way to take these strategies and apply them into the ETF format, we can offer ordinary investors the ability to effectively borrow money at negative rates for a long term.
Well, and you can do so because you're doing in an option structure.
Yep.
You can do it in a non-recourse fashion. Right?
Well, that's the other magic over here in all these trades is that you're buying one option and that's it, which means your loss is known. The strategy we've described where it came at $50, it's 25 of option and 25 of treasury. The most you could lose in every scenario is 25. I mean, the treasury is not going to default. And you can make infinite. Products designed like that are rather fancy because you know what your loss is and you have leveraged upside, which means that the first bit you make $1, the next bit you make $1.50, the next bit you make $2 because you're along the optionality, you're along that convexity. Remember, convexity basically means that you could make or lose in an unbalanced fashion. If you make $1 or lose $1, zero convexity. If you make 2, lose 1, positive convexity. Lose 3, make 2, negative convexity. The reason why we hired all these physics PhDs once upon a time is someone had to go and figure out if I have one bond that pays 1 to 1, another that's 2 to 1, another that's negative 3 to 2, what should be the yield of each of those 3 bonds relative to a treasury security? It's doable if you have enough horsepower behind you, and that's why we hired them. And that's what we did on Wall Street, is basically analyze all these embedded options. A corporate bond, what is that? It's a treasury plus a default option on a corporation. So you can break it into pieces and analyze it. Simplify is taking this hard-fought analysis, optimizing it, and putting it into a liquid ETF form.
You know, one of the things that's so exciting for me is at Simplify, we're increasingly moving towards combining the products together, effectively building the recipe out of the ingredients and putting it forward. And that creates some really interesting tax dynamics as well.
Next generation stuff, stay tuned.
I think that's a great place to wrap up. Harley, as always, it was just awesome to sit down with you. Thank you so much.
Thanks, Mike.
The financial tsunami of stocks and bonds moving down together would wreak havoc on most portfolios, setting off a chain of liquidation that would devastate financial markets. But for the first time ever, every investor is able to hedge this risk like the pros, with Simplify's PFIX interest rate hedge ETF. By taking advantage of changing regulations and using the type of OTC options previously only available to the largest and most sophisticated investors, Simplify is democratizing access to some of the best ways to protect yourself from the biggest risks in the market today.